Supermicrocomputer builds the high-performance servers and infrastructure that sit at the very core of today's artificial intelligence, AI data centers, AIDC. These centers are not just any computing hubs, they are the beating hearts of AI innovation, processing massive data sets for generative AI, machine learning, and complex simulations. In this environment, speed and efficiency are paramount. Companies are no longer satisfied with slow, step-by-step data center construction. They increasingly demand data center building block solutions, pre-designed, pre-validated infrastructure modules that allow for faster deployment, quicker operational readiness, and reduced time to market. These modular systems provide an optimized balance of performance and cost efficiency, cutting down on energy consumption, water usage, and operational complexity while maximizing compute density. Supermicro's latest strategic move aligns perfectly with this industry-wide shift. At Mobile World Congress 2026, the company announced a high-profile collaboration with SK Telecom, SKM, and Schneider Electric, SBGSF, SBGSY, aiming to redefine the next generation of AI data center construction. The three companies plan to co-develop a prefabricated modular system that integrates high-performance AI servers with all the necessary power and cooling infrastructure into a single, ready-to-deploy module. This approach allows companies to scale their data centers like building blocks, stacking capacity efficiently and avoiding the delays associated with traditional construction methods, which can take months to complete. By simplifying deployment, these modules help clients respond rapidly to the exploding demand for AI compute resources while simultaneously controlling operational costs. In this partnership, each company brings a unique strength to the table. SK Telecom provides operational expertise, drawing from years of large-scale telecom and data center operations. Supermicro contributes its renowned high-performance GPU servers, which are optimized for AI workloads and designed to handle intense compute demands. Schneider Electric rounds out the package with state-of-the-art power management and infrastructure solutions, ensuring that each module operates at peak efficiency. Together, the trio is positioned to capitalize on the global surge in AI infrastructure demand, putting Supermicro at the forefront of the next data center expansion wave. Supermicrocomputer, founded in 1993 and headquartered in San Jose, California, has a long-standing reputation for innovation in servers, storage, and networking solutions. The company caters to enterprise data centers, cloud providers, and hyperscale operators, earning recognition as a critical enabler of digital transformation and AI deployment worldwide. With a market capitalization of $19.6 billion, SMCI has proven resilient in the face of market volatility, continuing to innovate across rapidly evolving segments such as AI, high-performance computing, HPC, and edge data centers. Its ability to adapt and anticipate industry trends has helped it secure long-term relationships with global technology leaders, reinforcing its status as a key player in tech infrastructure. Investor sentiment has reflected both the promise and challenges of this growth trajectory. Supermicro's shares surged during the AI server boom, as investors sought exposure to companies powering the AI revolution. However, the momentum cooled after the release of fiscal Q1 2026 results in early November, which highlighted the classic trade-off between growth and profitability. While revenue growth remained strong, margins were under pressure, leading to a cautious response from the market. Consequently, SMCI stock dipped, erasing some of its earlier gains and ending the year in the red. Over the past 52 weeks, the stock has declined roughly 16.6%, with nearly a 20% drop over the last 6 months, and it has fallen nearly 50% from its July peak of 62.36. Despite this, the tone entering 2026 appears cautiously optimistic. Year-to-date, SMCI stock has risen approximately 10.9%, reflecting renewed investor interest and confidence in its AI-driven growth strategy. The strong Q2 report further boosted the stock, pushing gains into the mid-teens percentage range. Technical indicators reinforce this sentiment shift. Trading volume has increasingly skewed toward green days, signaling renewed buying interest, while the 14-day Relative Strength Index, RSI, which fell into oversold territory in November, has climbed back toward a neutral reading at 52.67. This suggests that the stock may be regaining balance after a period of heavy selling pressure, with investors gradually recognizing the company's fundamental strength rather than reacting purely to short-term volatility. Insider activity has further bolstered confidence. When CEO Charles Liang and CFO David Wagan purchased shares in February, It sent a strong signal to the market that company leadership believes in SMCI's growth prospects. Insider buying often resonates more than press releases because it reflects executives' personal conviction in the company's trajectory. From a valuation standpoint, SMCI is trading at 14.59 times forward-adjusted earnings and 0.47 times forward sales, metrics that are below sector averages and the company's historical medians. For a company so deeply embedded in the AI infrastructure boom, these figures suggest that the stock may be undervalued, presenting a compelling opportunity for long-term investors who recognize its strategic positioning. The release of Supermicro's fiscal Q2 2026 report on February 3rd marked a significant turning point. After several quarters of cooling growth, investors were keen to see evidence that the AI growth story remained intact. The report did not disappoint. Revenue soared to $12.68 billion, up an astonishing 123.4% year-over-year, YOY, and 153% from the prior quarter. This not only exceeded Wall Street expectations, but also surpassed management's own guidance range of $10 billion to $11 billion. Non-GAAP earnings per share rose to 0.69 from 0.59 in the previous year, again beating consensus estimates and demonstrating strong operational execution. Some of the Q2 surge reflected timing adjustments. Approximately $1.5 billion in shipments had been delayed from Q1 due to customer readiness constraints, effectively boosting Q2 revenue. However, even accounting for this, the underlying demand remained robust and broad-based. The primary driver continued to be the rapid adoption of rack-scale AI systems, as enterprises and cloud providers raced to expand AI infrastructure, despite ongoing supply chain and component challenges. This strong uptake underscores the centrality of AI GPU platforms to modern data center architecture.